What if the biggest market shock of the next decade doesn't come from Wall Street, but from a quiet decision made thousands of miles away, one that most investors won't notice until it's already too late? A move so large that it could drain liquidity, reprice assets overnight, and expose how fragile Western markets really are. Because today we can't be talking about China as $8 trillion lever and why it might be the trigger that changes everything. When people hear the phrase China's $8 trillion move, it sounds abstract, almost exaggerated, but it isn't a single button being pressed or one dramatic headline event. It's a slow, deliberate repositioning of financial power that has been building for years. To understand it, we first need to zoom out and look at the scale of China's balance sheet relative to the global system. China sits at the center of a massive web of assets that includes roughly $3 trillion in foreign exchange reserves, trillions more in state-owned bank assets, policy, bank lending, sovereign funds, and overseas investments tied to trade infrastructure and commodities. When analysts talk about an $8 trillion move, they're not saying China has $8 trillion in cash sitting idle. They're talking about the cumulative financial firepower China can redirect by changing how it allocates reserves, settles trade, manages debt, and backs its currency. And in a world built on confidence and liquidity, even a partial shift of that magnitude matters more than most people realize. Western markets, especially the US and Europe, are deeply dependent on two things that rarely get questioned during bull markets: cheap capital and constant demand for their debt. For decades, China has been one of the largest buyers and holders of Western financial assets, particularly US Treasuries. That demand helped keep interest rates lower than they otherwise would have been, supporting everything from stock valuations to housing prices. When China buys treasuries, it isn't just a trade, it's liquidity flowing into the heart of the system. But what happens when that flow slows, reverses, or gets redirected somewhere else? Imagine a massive dam upstream that has been quietly feeding a river for years. If the dam doesn't collapse but simply reduces the flow, the river downstream still shrinks, boats scrape the bottom, and ecosystems change. Markets work the same way. China's strategic goal has never been mysterious, if you read between the lines. Stability at home, resilience against external pressure, and reduced dependence on a system dominated by the US dollar. Over the last decade, China has steadily increased gold reserves, encouraged trade settlement in yuan, built alternative payment systems, and expanded bilateral trade agreements that bypass the dollar entirely. None of these moves alone collapses Western markets. Together, they begin to erode the plumbing that keeps those markets functioning smoothly. Liquidity is the oxygen of finance, and the dollar system has been the main oxygen tank. If a major player starts bringing its own supply, the entire room feels different. The $8 trillion concept also includes China's domestic financial system, which is often misunderstood. Chinese banks hold enormous asset bases, much of it tied to government policy objectives rather than pure profit. This gives Beijing a level of control Western governments can only dream of. When China decides to stimulate, restrict, or redirect capital, it can do so at a scale that dwarfs most central banks. If that capital is increasingly aimed inward or toward strategic partners instead of Western assets, the impact ripples outward. Less foreign demand for Western bonds means higher yields. Higher yields mean higher borrowing costs. Higher borrowing costs pressure governments, corporations, and households simultaneously. That's how stress moves from an abstract bond market into everyday life. Now add historical context. Empires and financial systems rarely collapse because of a single catastrophic event. They weaken through gradual shifts in trade routes, reserve assets, and confidence. Britain didn't lose dominance overnight. It lost it as global trade and reserves shifted away from sterling toward the dollar. Today, the dollar still dominates, but cracks are forming at the edges. When China settles energy trades in yuan or stockpiles commodities rather than paper claims, it's not making a political statement, it's managing risk. Gold in this context becomes especially important. Gold is not someone else's liability. It doesn't depend on a payment system or a promise. When central banks, including China's, accumulate gold while reducing exposure to foreign debt, they're quietly voting with their balance sheets. For precious metals investors, this matters more than flashy headlines about daily price moves. If Western markets face sustained selling pressure in bonds while governments continue running large deficits, central banks are forced into a corner. Either allow yields to rise and risk recession, or intervene by printing more money. Historically, that's when hard assets begin to shine. Gold and silver aren't magic, they're mirrors. They reflect confidence, or the lack of it, in paper systems. When trust is high, metals look boring. When trust erodes, they suddenly make sense to everyone at once. The danger for Western markets isn't that China dumps everything tomorrow. That would hurt China too. The real risk is a controlled, strategic rebalancing that the market slowly realizes it can't reverse. Think of it like a large shareholder quietly reducing their stake over time. Each sale seems manageable, until one day buyers realize the seller isn't done, and prices have to adjust to find a new equilibrium. That's when volatility spikes, correlations break down, and assets that once moved together start behaving very differently. Stocks, bonds, and real estate can all reprice in ways that surprise people who assumed yesterday S relationships would hold forever. At the heart of this story is leverage. Western markets are heavily leveraged on the assumption of low rates and abundant liquidity. China's $8 trillion lever isn't about pulling wealth out of the system entirely. It's about changing where that leverage points. Less support for Western debt, more support for domestic resilience, commodities, and alternative trade frameworks. The shift doesn't need to be dramatic to be effective. Even marginal changes, sustained over years, can redefine what normal looks like. The markets are terrible at pricing slow-moving structural change until it's suddenly obvious. So the real question isn't whether China wants to collapse Western markets. It asks whether Western markets are prepared for a world where a major pillar of demand and liquidity is no longer guaranteed. History suggests transitions like this are messy, uneven, and full of opportunities for those paying attention. They punish complacency more than anything else. As we move forward, the signals won't always be loud. They'll show up in bond auctions, currency swaps, central bank balance sheets, and the quiet accumulation of real assets. That's where the story is unfolding right now, and that's why understanding this $8 trillion move isn't optional anymore. It's essential. Now the picture gets more complex, because once you understand the scale and intent behind China's repositioning, the next step is seeing how this pressure actually transmits into Western markets in real time. Financial systems don't break all at once. They strain, they creak, and they reveal stress in places most retail investors rarely look. One of the first pressure points is the bond market, because bonds are the foundation of everything else. Government bonds set the so-called risk-free rate, and every other asset is priced off that baseline. If China gradually reduces its appetite for Western debt, especially U.S. Treasuries and European sovereign bonds, yields don't just rise on paper. They ripple outward into mortgages, corporate loans, credit cards, and business investment decisions. A move that sounds like it belongs in a central bank report ends up determining whether a family can afford a home or a company can refinance its debt. Over the last few years, we've already seen hints of this dynamic. Foreign participation in U.S. Treasury auctions has become less reliable, forcing domestic buyers and the Federal Reserve to step in more aggressively. When the Fed buys bonds, it expands its balance sheet, effectively creating money to absorb supply. It keeps yields from spiking too fast, but it comes at a cost. More money chasing the same amount of goods eventually shows up as inflation, even if it takes time to filter through the system. This is why inflation doesn't feel like a single event, but a persistent grind that erodes purchasing power. When China chooses to allocate capital away from Western bonds and toward real assets, infrastructure, or strategic reserves, it indirectly increases the burden on Western central banks to keep the system stable. Currency markets are another transmission channel, and they're often misunderstood. The US dollar's dominance isn't just about trade, it's about trust, liquidity, and depth. Everyone uses dollars because everyone else uses dollars, but that network effect weakens when large players start building alternatives. China has spent years promoting yuan-denominated trade, not to replace the dollar overnight, but to create optionality. Optionality is power. If energy, commodities, and manufactured goods can be settled outside the dollar system, even partially, demand for dollars at the margin declines. That doesn't crash the dollar instantly, but it does change the long-term trajectory. A slightly weaker dollar can help exports, but it also raises the cost of imports, especially commodities priced globally. Again, this feeds back into inflation and living costs in ways people feel before they fully understand why. This is where precious metals enter the conversation more forcefully. Central banks don't buy gold because they expect quick profits. They buy it because gold sits outside the credit system. It has no counterparty risk. When China increases its gold reserves while reducing exposure to foreign debt, it's signaling a preference for assets that can't be frozen, sanctioned, or devalued by another country's policy decisions. For Western investors, this should sound familiar, because historically, periods of monetary transition are when gold and silver reassert their role. Silver, in particular, has a dual identity that makes it fascinating in this context. It's both a monetary metal and an industrial input. As China invests heavily in green energy, electronics, and infrastructure, silver demand rises, even as monetary uncertainty supports investment demand. That combination can create supply pressures that aren't obvious until prices adjust sharply. Equity markets, meanwhile, often appear calm right up until they aren't. Stocks can ignore rising bond yields for a surprisingly long time, especially when earnings are strong or narratives are compelling. But higher rates eventually force a reckoning. Valuations are mathematical constructs, and when the discount rate rises, future earnings are worth less today. Companies that relied on cheap debt to buy back shares or fund growth suddenly face tougher choices. Margins compress, layoffs begin, and confidence shifts. If this process coincides with reduced foreign capital inflows, markets lose an important stabilizer. Volatility increases, and correlations that investors relied on for diversification can break down. China's $8 trillion lever also interacts with geopolitics in ways that markets struggle to price. Sanctions, trade restrictions, and financial weaponization have taught many countries a hard lesson about concentration risk. If reserves can be frozen and payment systems can be cut off, then diversification becomes a survival strategy, not an ideological one. China isn't alone in this thinking, but its scale makes its actions disproportionately influential. When smaller nations follow China's lead by holding more gold, trading in local currencies, or reducing exposure to Western debt, the cumulative effect grows. Each individual decision seems manageable, but together they reshape the landscape. For everyday investors, the challenge is separating signal from noise. Headlines scream about daily market moves, but the real story unfolds in slow-moving data. Central bank balance sheets, reserve composition reports, trade settlement statistics, and commodity stockpiles tell a clearer story than social media panic ever will. If you zoom out far enough, you see a pattern of de-risking away from paper promises and toward tangible value. That doesn't mean paper assets become worthless, but it does mean their risk profile changes. What felt safe in a world of abundant liquidity can feel fragile when that liquidity becomes conditional. Think of the global financial system like a massive suspension bridge. It was engineered for certain loads and stresses, assuming traffic would flow in predictable ways. China's gradual shift doesn't blow up the bridge, but it reroutes traffic. Some cables take on more weight, others less. Over time, weaknesses become visible, maintenance becomes more expensive, and eventually, everyone realizes the structure needs reinforcement or redesign. Precious metals are not the bridge itself, but they're like the solid ground beneath it. They don't move as fast. They don't promise returns, but they're there when the structure above starts to sway. As this transition continues, expect contradictions. Markets can rally even as underlying risks grow. Inflation can fall temporarily while long-term pressures build. Policymakers can claim victory even as balance sheets expand quietly in the background. China's $8 trillion move isn't about timing a crash. It's about changing the odds. It tilts the tables slowly, forcing Western markets to adapt to a world where assumptions that held for decades no longer apply. The investors who struggle most will be those who assume tomorrow will look like yesterday. The ones who do better will be those who understand cycles, history, and the value of owning assets that don't depend on anyone else. One's promised to pay end. End is where the story becomes the most uncomfortable because once a system reaches the later stages of transition, the choices narrow and the consequences accelerate. This is the phase where markets stop responding mainly to narratives and start responding to constraints. Western economies today are constrained by debt levels that would have been unthinkable a generation ago. Governments roll over trillions in obligations every year. Corporations depend on refinancing to survive, and consumers carry balances that only make sense when rates stay relatively low. China's $8 trillion lever presses directly on those constraints by challenging the assumption that global capital will always line up to fund Western deficits at acceptable prices. When that assumption weakens, policymakers are forced to choose between financial stability and currency stability, and history shows they rarely get to keep both. If yields rise too far, too fast, something breaks. It could be a bank exposed to long-duration bonds, a pension fund struggling to meet obligations, or a housing market that suddenly freezes because buyers can't qualify for loans. We've already seen previews of this dynamic in recent years, where sharp moves in rates cause stress in unexpected corners of the financial system. Each time, central banks stepped in to stabilize conditions, expanding balance sheets or offering emergency facilities. These interventions work in the short term, but they reinforce a long-term pattern. Losses are socialized, debt is rolled forward, and the currency absorbs the adjustment. This is why confidence becomes the ultimate variable. As long as people believe the system will hold, it does. When belief falters, even slightly, reactions can become nonlinear. China's repositioning adds pressure at precisely this psychological level. It's not just about flows of money, it's about signaling. When a major economic power consistently favors hard assets, alternative trade mechanisms, and reduced exposure to foreign debt, it sends a message to other participants in the system. You don't need to agree with China's politics to understand its risk management logic. If you are running a household with most of your savings tied to one employer's promise, and that employer began changing the rules, you'd look for diversification too. On a global scale, diversification means less blind trust in fiat systems and more emphasis on assets with intrinsic value. This is why gold's role keeps resurfacing whenever monetary regimes shift. Gold doesn't generate cash flow, and it doesn't innovate, but it has one unique property that becomes invaluable during transitions. It settles balances without relying on trust. Throughout history, when trade networks reorganize and currencies compete, gold quietly bridges the gap. Silver often follows, amplified by its industrial demand and smaller market size. In a world where green technologies, electrification, and digital infrastructure expand rapidly, silver's dual role creates a tightrope between scarcity and utility. Investors don't need to believe in conspiracy theories or imminent collapse to see why central banks and long-term holders value these metals during uncertain times. For Western markets, adaptation is possible, but it requires honesty about trade-offs. Higher rates mean slower growth. Fiscal discipline means political pain. Structural reform means winners and losers. These are hard conversations, especially in societies accustomed to credit-fueled expansion. China's $8 trillion move doesn't force immediate failure, but it reduces the margin for error. It shortens the runway. Policies that might have worked in a world of endless foreign demand for debt become riskier in a world where that demand is selective and conditional. The system becomes more sensitive to shocks, whether they come from geopolitics, energy markets, or internal imbalances. Investors watching this unfold should resist the urge to think in binaries. This isn't about the dollar disappearing tomorrow or Western markets going to zero. It's about repricing. Assets are valued based on expectations of growth, stability, and purchasing power. When those expectations shift, prices adjust. Sometimes slowly, sometimes violently. Diversification, in this context, isn't just owning different stocks. It's owning different kinds of risk. Paper claims, real assets, productive businesses, and monetary hedges each play a role. Precious metals fit into this picture not as a bet against civilization, but as insurance against policy mistakes and structural change. The most dangerous period in any transition is when complacency collides with reality. When people assume central banks can always fix things, they underestimate the limits of monetary tools. Printing money can solve liquidity problems, but it can't create real resources. It can't manufacture trust once it's lost. China's strategy highlights this truth by focusing on tangible capacity, infrastructure, commodities, manufacturing, and reserves that exist outside another country's control. Western economies still have enormous strengths, from innovation to deep capital markets, but those strengths need a foundation that isn't endlessly diluted. As this story continues to unfold, pay attention to what governments and central banks do, not just what they say. Watch reserve trends, commodity flows, and balance sheet expansions. Notice how often temporary measures become permanent. Ask simple questions like who is funding deficits, at what cost, and for how long. These questions cut through noise and point directly to sustainability. China's $8 trillion lever doesn't guarantee collapse, but it does force a reckoning with reality. And reality, in finance, always asserts itself eventually, whether through gradual adjustment or sudden shock end. China's $8 trillion move is not a single event or an overnight trigger, but a long-term strategic shift that exposes how dependent Western markets have become on cheap capital, constant liquidity, and unquestioned trust in paper systems. By reallocating reserves, reducing reliance on Western debt, building alternative trade frameworks, and accumulating hard assets like gold, China is changing the rules at the margins, where real pressure builds. This shift raises borrowing costs, strains debt-heavy systems, and forces central banks into difficult choices between stability and currency value. History shows that during such transitions, assets reprice, assumptions break, and precious metals regain relevance as anchors of confidence. The lesson is not fear, but awareness. Markets are entering a phase where discipline, diversification, and understanding structural change matter more than ever, because in a world that is quietly rebalancing, complacency is the greatest risk of all.